Americans have never had it as good as we have it right now. And I mean the vast majority of Americans have never had it as good as we have it right now. This nation does not need to be saved. Americans do not need to be provided an even greater standard of living.
Today's guest is one of the most respected economic voices in the country, Dr. Chris Thornberg. Chris is the founding partner of Beacon Economics, a leading independent economic research and consulting firm. He first rose to national attention while serving as a senior economist at the UCLA Anderson forecast, where he was one of the first economists to sound the alarm on the housing bubble and correctly predict the Great Recession. Was there a housing bubble?
Just a little bit of one.
Dr. Doom, is that what you said they called you? Since then, Chris has become a trusted advisor to Fortune 500 companies, government agencies, and investors, known for his bold, data-driven insights on everything from real estate markets to fiscal policy. His contrarian but accurate takes have been featured in the Wall Street Journal, Bloomberg, New York Times, and NPR. Before we dive in, don't forget to like, share, and subscribe to the Matthews Mentality Podcast. Chris, welcome to the show.
It's great to be here.
Thanks for coming out to Nashville. Now, I'm going to dive in, okay? It's Thursday, September 4th, all right?
Yeah.
We got a big jobs report coming out tomorrow. There's so much talk right now, more than normal, at least from my vantage point, about the economy, because we have everything that's going on with the current administration and the Fed and rate cuts. We have concern about a weakening or softening job market and labor market. Why don't you just, for the audience sake, for my sake, just tell me, in your opinion, like what's happening high level of the economy? What do you see? What does your crystal ball show you over the next 12 months? Just what's going on?
There's little doubt that there's a rising level of risk in our economy, risk of some sort of large shock turning into a recession. That said, I don't think people are paying enough attention to where the risks are coming from. It's not exactly what you think. And with that said, I think if I had to just put my money on the table, the economy is going to continue to grow the next year. We're not going to have a recession. But risks are clearly growing. And so as an economist, and everybody wants to know what's going to happen next, one of the things I have to first acknowledge is, well, predicting the future is really hard. I think there's an old expression about that. But forecasting is difficult, particularly the future. And that's what we're dealing with. When you're thinking about an economy that is out of balance, that has some particular void that at some point in time that bubble's going to collapse. Yet it's incredibly hard to tell exactly when that's going to occur. In fact, and again, there's lots to talk about here, but in a very real sense, it's funny because you brought up the fact that one of my first big calls, what launched Beacon Economics, was my call on real estate. And I really started feeling worried about real estate in 2004 and what it meant for the economy in 2004. It wasn't really until 2006 when I started really sounding the alarm and ended up leaving UCLA to start my own company about that point in time. And in the end, it wasn't until really the third quarter of 2008 that it was finally broadly acknowledged that there was something really going wrong. And of course, when the stock market dropped and the credit market seized up and Ben Bernanke and company were desperately running around trying to put the fires out, well, then we all acknowledged, looks like something happened. But the beginning of that, at least as far as I could tell, happened back in 2004. So think of that length of time when you started to see the imbalances till the imbalances finally showed up in that quarter growth rate.
It's longer than you would think, or I would think looking back.
Yeah.
I got into real estate in 2004. That was the first sign that there was something wrong with the industry.
Yeah.
That
Absolutely.
They would hire me.
Yeah.
That is the bubble. That's the personification. But no, I mean, yeah, it's interesting for you to see it really 3 or 4 years before the layman's like myself really, I don't want to say see it, just felt it.
Yeah. And what I saw, by the way, and I should be really clear about this, because when you think about economics, I call myself kind of a Main Street economist. I'm not a Wall Street guy. I don't sit around parsing the stock market numbers and discussing the PE ratios of 300 different stocks and become focused to the point of obsession on every word that comes out of Jerome Powell's mouth. Don't do that. But what I do pay attention to is what I call the flows in the normal economy. What's happening with consumer spending? What's happening with business investment? What's happening in terms of the savings rates and how are people operating? How are they living their lives? When you look at the world in that sort of way, and you take a step back from those financial metrics, I think you get a different view of things. So from that perspective, what did I start seeing in 2004 and 2005? Well, the thing that really started worrying me was what seemed to be an excessive amount of consumption. That is to say, you saw consumer spending as a percent of GDP going up. You saw U.S. economy opening a very wide trade deficit. You saw us importing lots of capital from the rest of the world. And none of that made any sense to me. The U.S. economy was basically being driven by a consumption boom, and a consumption boom that wasn't linked to what I would call real increases in productivity. Rather, it was a consumption boom driven by a feeling of prosperity that wasn't really there. And that's what started to scare me. Now, flash forward a few years, I left UCLA. One of my first clients was a hedge fund out of New York, Polson and Company. And I ended up working with them for over 10 years. In fact, John Polson famously made some bets against real estate that made him a ridiculous amount of money in a couple of those years. And when I went there and I sat down with the Wall Street economists, guys who were on the other side of that equation, and started listening to their stories, and of course, those stories were about asset-backed securities and synthetic products that were created that were linked completely as asset-backed
AAA
securities.
rated, baby.
Yeah,
What could go
and
wrong?
somehow or other, they were taking massive quantities of these incredibly junky subprime loans and packaging them up to 85% AAA gold-plated bonds. And I went, oh, now I get it. Now I see the other side of the mechanism. Now I understand why what I saw on the surface was being driven underneath the situation.
So talk to me about today's market,
Yeah.
business spending, savings rates, consumer
Yeah.
spending. Like, how is it looking?
Well, yet again, I appreciate when you pick up the newspaper, most Americans are busy whining about their lives. Yet, in a very real sense, Americans have nothing to whine about. We have right now in the United States one of the highest quality of life, one of the strongest household sectors we have ever seen. And what do I mean by that? Well, look, yes, we've had a slowdown in job growth, but we still have very tight labor markets. There's still plenty of job openings out there for people who are looking for work. Wages are still going up. Household incomes in real terms at an all-time high level. You have a net worth at an all-time high level. And I know it's easy to say, well, that's all the top 5%. But even when you start looking at some of the breakdowns, for example, the Federal Reserve does some breakdowns of net worth, and you look at the bottom 50% of Americans, they've seen their net worth go up by a factor of 3 in the last 8 years or so. Now, it's still very low. They still control way too little of the aggregate wealth in the United States. But clearly, those trends are moving in the right direction. Household consumption at an all-time high level. Debt-to-income ratios really low, at a 30-year low right now. So everywhere you look, households are in an incredible place. So everybody's complaining, but in reality, we've never had it quite this good. But here's the point. The problem in our world is why households have it so good.
Okay.
That's the functional issue. Oh, why are incomes so high? Well, it's pretty clear because we don't have to pay a couple $1 trillion of taxes every year to pay for all these federal expenditures that are going on right now. We're not paying the bills. Somebody else is. And then, of course, there's all these people, domestic and foreign, who are buying U.S. treasuries at a record level. So our incomes aren't as high as we think they are. Why are net worths so high? Well, net worth is so high because home prices are through the roof, because the stock market has the second highest PE ratio ever, because people think cryptocurrency has real value when it clearly doesn't. So what's going on in our world is we have a huge deficit problem at the federal level, federal government level. We have a huge asset bubble ripping through our economy right now. And the combination of those two things is creating a world in which right now things look really good, But at what point in time does reality start intruding on itself in terms of the fact that that government deficit is unsustainable? These asset prices are unsustainable.
In your opinion, what is the biggest risk to, kind of metaphorically popping that bubble?
Yeah. Rest of the world. Again, go back to the metaphor, the analogy, whatever you want to call it. I always get confused between those two things.
Yeah, me too. I just say metaphor and hope nobody checks me.
Nobody checks me on it, right? If you go back in time and you think about the beginning of Beacon Economics almost 20 years ago, it's really similar to where we are today. Because while the underlying economy looks like it's doing fine, what I see in the entire big picture is a growing imbalance. And in this case, let's yet again go back to the trade deficit. Look, last year, the U.S. economy, we had a trade deficit of a little over $1 trillion a year. Now, the knee-jerk reaction to that statistic is, well, it's because the rest of the world is unfair. They have trade barriers and they prevent us from exporting stuff. And of course, as any economist will tell you, that's nonsensical. That's not how it works. The trade deficit is the difference between what we as a nation consume and what we produce. If we have a $1 trillion trade deficit, it's because we are consuming $1 trillion more than we are actually producing, and ultimately that's on us. Now, how are we able to afford this? And the answer has been there's been an incredible inflow of money from the rest of the world. Hot money. That's a term that economists use for what we call financial investment, as opposed to FDI, which is when you go and you buy a factory, you build a factory in a foreign country, another country. Hot money is portfolio investment. You're buying bonds, you're buying stocks. Well, the inflows of hot money from the rest of the world right now, net, are about $1.2 trillion. What does that mean? Well, go back to the federal deficit and recognize that ultimately, no matter how you look at it, you've got tons of money coming into this country, and it is funding that federal deficit. That's the weak part right there. Why is the money coming into the country? They're not coming here to buy U.S. treasuries. I think they're smart enough not to do that. What are they buying? Well, they're buying equities, particularly AI equities, or they're buying crypto, or they're perhaps buying real estate. Whatever it is, they're chasing yields because yields in the United States are higher than they are in the rest of the world. And that's the functional problem. At some point in time, they're going to realize that those yields aren't real. Asset prices are going to start returning to something resembling normalcy. And when that happens, that money stops coming in, the dollar starts to drop, and that means we have to start funding our own government deficit, which means another increase in interest rates. So we're talking about an increase in interest rates and an increase in inflationary pressures happening all basically simultaneously, even as equity prices are dropping. And that is the risk.
That's the stagflation concept.
Yes.
Yeah.
I think you could call it stagflation. I think, well, the term stagflation, I think, is a little misleading. That's a whole economic history thing we don't have to get into here. But yeah, that would be a situation by which the U.S. economy hit with another increase in interest rates. That's where the risks start to arise.
Timing on something like this potentially happening, the rest of the world, let's say inflow $1 trillion a year of hot money investment to the U.S., realizing that the returns they're seeking maybe aren't either as real as they thought, or they aren't happening anymore because for some reason the equities, real estate values are going down in the U.S. Like, when do you, if you were consulting a client, when would you?
When would I say when?
Yeah.
The answer is I have no idea.
Yeah.
And this goes back to two aspects of it. The first is we're talking about an irrational market at some level. I mean, the stock market has the second highest PE ratio ever. The only time the PE ratio in the stock market has been higher than it is today was in 1999. And we know what happened to the stock market from 1999 to 2001, which is it collapsed violently. Now, the key here is as soon as you say it's a bubble, by definition, you can no longer predict when it's going to end. It's like bubbles are like crazy people. If I could predict what they were going to say next, they're probably not crazy. And in a very real sense, if you could predict when a bubble would end, it's going to just everybody's going to buy until the bubble pops, and then sell the minute before. And then somebody else says, well, I'll sell a minute before that. And it immediately unfolds to ending right now. So you cannot predict these things. That said, what you can say is the risks are growing. And when, if you will, the right word goes in the wrong ear, that's when things start to tumble. We saw a brief episode of this earlier this year. In fact, I was very worried in April. April, of course, was the first round of tariffs, Liberation Day, the whole bit. And it wasn't necessarily the tariffs themselves that concerned me, but it was the perception of the tariffs and what it meant for the economy that was scary. What happened was, of course, the tariffs are going to go into place. The stock market started to drop. And what's typical is the stock market drops, the bond market rallies, interest rates come down. And that's happened for the first few days. That happened. And then until it didn't. Yeah. And what didn't happen was when the dollar started to drop. And when the dollar started to drop, the bond market started to drop and rates started to go up.
Yeah.
And you saw a little mini version of how I see this thing unwinding. Now, since that point in time, backed off the tariffs. The markets got a little bit of their mojo back. Since that point in time, we've started to recognize that tariffs aren't as big of a deal as the news was making out. And that's the key. You know, it wasn't the tariffs themselves that started the process. It was the narrative about the tariffs.
Yeah, I always say it's not the message, it's the delivery.
Yeah.
But
yeah. And it's that narrative that caused the problem. Now, that's faded. But okay, so what's the next narrative? What's the next story that's going to rattle the markets? What is going to be that bit of information that finally turns off the optimism that leads to the cascade effect? And on that one, I don't know.
Well, you mentioned earlier the highest PE ratio since 99.
Yeah.
And, you know, I'm in real estate. I'm not in equities and stocks. But my understanding is there's 7 or 8 companies, and then there's everyone else. And everyone else is like, yeah, you know, it's decent times, but it's these 7 or 8s that are just bending the average up, right? And so part of, we were talking bubble, you had mentioned AI, is do you see any bubbles? Do you see an AI bubble? I've kind of heard, especially in the last month or two, GPT-5 came out and it was not like, you know, a materially better iteration the way the previous models were. And so now there's this talk like, are we kind of hitting our ceiling in AI as we kind of know it? And is that going to bring down the price of these 7 or 8 companies that is really driving this average increase in the S&P 500? Like, what do you see happening there?
Yes, the scenario you just gave me seems perfectly reasonable. That said, I don't think it necessarily. When you dive into this kind of conversation, it's almost like starting to count how many angels can sit on the head of a pin. You're becoming a little too technical when you think of it that way. Because most people don't respond to specific equities. They respond to the indexes. They respond to the collapse of the S&P 500. They respond to the collapse of the NASDAQ. I think if you see those 8 companies start to see their stock prices drop and it drags the indices down, the fact that the indices are dropping is what's going to worry the markets. It's going to scare those foreign investors. They're not going to say to themselves, "Oh, it's just 8 stocks. It's just 8 companies. It's fine." They don't view it that way. They view it in the aggregate. And if those guys come down, it gets rid of overall demand to be in this economy. And that, again, is what slows down or stops that inflow of cash. Cue the drop of the dollar, increase in import prices, the rise in interest rates. Now, one thing I didn't say, and I don't want to take us too far off topic back to where you were going here, but when it comes to the second increase in interest rates, understand that the scary thing about that increase in interest rates isn't exactly that it would hit, say, real estate or even households that hard. I mean, real estate muddles through as best they can. Households are remarkably interest rate insensitive right now because most household debt is in the form of a 30-year fixed rate mortgage. But the one part of the economy that is not insulated from interest rate increases is, of course, the biggest borrower overall, the federal government.
Yeah.
A 1 percentage point increase in the interest rate on existing government debt causes another $400 billion a year in
Interest
borrowing.
expense, yeah.
So another increase in interest rate could quickly set us into one of these debt deficit bubbles, where the increase in interest costs causes the deficit to get larger, causing more borrowing, creating even more pressures until yet again, there starts to be a loss in confidence in the government's ability to pay off their debt. Cue, of course, the massive panic around government debt, and it gets very ugly very quickly.
Recently, I've heard this administration in dealing with this concern and topic, and really Besant, I think, came out and said it was like a 3-3-3, and one of the threes was we're going to grow the economy at 3%, and we're going to grow our way out of this deficit, and the way we're going to do that is an increase in American productivity and or efficiency. I think today we did get a report about American productivity that was higher than expected. I didn't dive in before breakfast this morning, admittedly. I mean, is that something you see? Do you see AI impacting future labor markets and creating this efficiency that allows us to, from a productive sense, kind of grow our way out of this debt deficit we found ourselves in? We put ourselves
those
in.
are two completely different questions, by the way. Because one of the questions is...
any good journalist will always ask two questions.
I know, but... And any good economist is going to take it apart.
Yeah,
First question is about the productivity in AI. Will AI increase worker productivity? I think the answer is absolutely it will. Is it going to be quite as wonderful as they're telling us? Well, no. I mean, tech always oversells their new technology. They have every single time going back. It's a standard. I have a new technology. It's going to change the world, and everybody's never going to have to work again. And it's never happened. Not going to happen this time. But yes, I think it will have an increase in overall productivity growth. The way we did see, actually, in the late 90s, early part of this century, we actually saw a pretty big increase in worker productivity growth that seemed to come from the internet, communication, our ability to do this stuff. By the way, that increase in productivity ended about 2006. Because that's when tech moved to social media. And social media is the exact opposite of productivity increasing. It's opposite. Yeah. It's productivity sapping. Now we're back to AI, which in theory will add more to the economy and get us going again. That said, does any of this justify the one big beautiful bill? And the answer is absolutely not. You can get that productivity growth without having to do all that borrowing. You could have put the U.S. on a sustainable path forward by increasing taxes and cutting spending and slowing down the pace of borrowing. And there's no reason in the world to think that doing that would somehow or other offset the ability for this nation to take advantage of AI and their productivity increases. So that's where I have a problem with that statement. He's trying to justify the deficit, and that doesn't justify the deficit.
Why do they keep spending?
Because we don't care. And by we, I mean you, me, and the vast majority of voters in the United States. Look, don't ever point at a politician and ask, why did they do that? Because in the end, politicians are a warped reflection of who we are. What do politicians sell? And the answer is a story. They get up on stage and they tell a story. And if you like that story, you vote for them. And if you don't like that story, you don't vote for them. When I think about the last election between Harris, I know a lot of people looked at that election and they saw two incredibly different people in so many different ways with different views of the world and coming from different places. I didn't see that. I actually saw two people who were both selling the same dangerous story. And the dangerous story both and Harris were telling the American people were that your lives are terrible and tragic, and it's all their fault, and I'm here to save you. That's not the case. Americans have never had it as good as we have it right now. And I mean the vast majority of Americans have never had it as good as we have it right now. This nation does not need to be saved. Americans do not need to be provided an even greater standard of living. Yet this is politics in the 2020s. This is what we have devolved into. which is the biggest pack of whiny brats on the global planet. And that's the dangerous part. It's the people we keep choosing to put in office who are telling us what we want to hear, not the truth.
Why do you think you spent a lot of time? One of the things we were talking about at breakfast is kind of human nature,
Yeah.
right? Emotion-based decision makers.
Yeah.
Why do you think most voters, that would be such an effective story?
Well, yeah. What we were talking about, I mean, to your point, is the fact that, look, I've been studying the economy for 25 years. And what have I seen in 25 years? Well, I started my career watching the tech.com bubble unfold. And I immediately watched us roll into the asset-backed security subprime nonsense, which didn't make any sense, which blew up spectacularly, caused enormous pain, created some really dangerous situations within our financial system that we managed to get our way out of. But that all happened, why? Well, because of weird beliefs about tech, then weird beliefs about housing. And then we went into the Great Expansion, which went from basically 2009 to 2020, 11 years.
Yeah, ZERP.
Yeah, and it was great. Incomes were up, people were doing great, and the entire 11 years we did nothing but whine and moan and complain. And somewhere in there, I started recognizing that all these wonderful models I was taught in grad school, there's something missing. There's some component of how we think about the rational agent, that person at the bottom of these models. There's something we are missing. And what I've done in the last really 5, 6, 7 years is read a lot more on human decision-making and getting more into behavioral economics and psychology and sociology, thinking about Daniel Kahneman's Thinking Fast and Slow, or Robert Schiller's Narrative Economics, or Jonathan Haidt's The Righteous Mind. And what I've started to recognize is that this rational agent model is not a good characterization for how humans think, how we view the world. Rather, we have an incredible degree of biases and filters on how we internalize information around us. And as a result of that, human beings don't see the world in a correct way. We have very distinct biases which color everything. And I believe that these biases shift, they move over time. I think that there are aggregate waves of these biases moving. And what I would argue is that when you're thinking about business cycles, we always want to talk about the business, the real flows within the economy. But to really understand what's going on, we have to throw on something on top of that, which is what I would call the narrative cycle. And the narrative cycle is how we think about the world and how we see the world around us. Right now, human beings, particularly human beings in the United States, have never had more access to more information. And somehow or other, what all that access to information has done has made us incredibly blind to what's really going on. Because all that information is feeding our biases, not feeding our intellect. And it's it's causing us to see the world in really dangerous ways.
Yeah, it's reinforcing at a greater and greater rate.
Absolutely. So we do live there's a joke in economics. The four most dangerous words you'll ever hear coming out of an economist's mouth, this time it's different.
Hold on. What did Reagan say? The most dangerous thing you could ever hear from someone is, "I'm from the government and I'm here to help." Yeah, that was a good one.
Exactly.
Yeah, Reagan was so talented. Dude.
He was great at the quip.
Yeah.
No, I
this
don't
time
think,
will be different.
This time is different. And so, all that said, I will argue that at some level we are in a really strange place. I think the information age is having a profound impact on how we view the world. And I think that how we view the world is becoming so distorted compared to what's really going on, that is the heart of the political and economic risk that we face as a nation. It's not the real flows, but these narrative flows.
Speaking of kind of like reinforcing your own biases, the echo chamber. Like, what's the worst economic policy you hear people consistently repeat today?
Cutting taxes will cause more growth.
Oh, it's a trickle down.
Absolutely.
Speaking of Reagan.
It's nonsensical. It doesn't work that way.
Yeah, Ronald Reagan, he was the worst.
Yeah, and every time you talk about people increasing taxes, the end is nigh, the end is nigh, the end is nigh. Now, don't get me wrong. I'm not suggesting that we should be cranking up taxes like nobody's business. But that said, if we're going to ask the government to pay all these money, well, then we have to pay for it.
Yeah.
And somehow or other, we think it's okay to borrow money to fund government purchases, but it's not okay to tax to fund government purchases. That's a real dangerous one.
I got a question. What do you think? Now, there's
by the way, that was a shot at the right. I got to take a shot at the left.
Yeah. Oh well, that's easy.
I got to be. I was going to say.
Yeah.
I mean, we could talk about rent control,
Oh,
which
no, we're going
is yet
to.
again reemerging, and minimum wages and all this stuff.
I got the meat of our conversation. I actually want around housing and regulatory policy and rent control and all those fun things as a real estate professional. Really fire me up. But we're going to get there. There's a data point of the most, it's like, I got to make sure I frame this. It's the amount of revenue the government can collect up to a certain point. Like, you can't raise taxes forever because eventually the revenue will actually start to go down because the economy goes down because the taxes is so burdensome. But then
that's the Laffer curve.
The Laffer curve.
Right.
Thank you.
Yeah.
Thank you. The Laffer curve.
Yeah.
Because if your taxes are super low, even if the economy is ripping, you just, as a percentage, you're just not collecting it. So the Laffer curve.
But what makes me crazy about the Laffer curve is Laffer didn't invent it.
No?
No. It's the most odd. Look, a long time ago, economists knew that if you had a 100% tax rate, you're going to get zero revenues.
Yeah.
That's not complicated, and that's all Laffer was saying, okay? This is obvious. It was obvious long before Laffer supposedly wrote it on a napkin. That said, the key here is at what point in time have the tax rate cross that threshold? And the answer is never, not in the United States. I mean, maybe in small markets in some cases, but for the most part, we're nowhere near that point.
So what I wanted to ask you, if you had the power of president and both Congress, the Senate, and the House, and you could set the tax rate.
Yeah.
What would, in your opinion, what would the ideal individual and corporate tax rates be?
Oh, that's way too complicated.
Come on.
Yeah, I wouldn't be able to. I would probably get rid of corporate taxes, but I would increase income taxes. I would get rid of capital gains taxes, but I would impose a wealth tax.
A wealth tax, like not an inheritance tax. Like
No, a wealth tax. You should get taxed on how much wealth you hold. That said, we should be able to buy and sell assets tax-free.
Oh, that's controversial, a wealth tax, because part of, like, from a real estate perspective, now stocks, it's easy. It's like, what is it trading at? But like, well, if I owned $100 million of real estate, just to use a round number,
right,
and you're like, okay, well, anything over 10 million, you should get taxed at 50%, because who needs that?
No. First of all, if you had a wealth tax, it would be much lower than that. It would be like 0.1% or 0.2%.
Okay.
It would be a small number.
Because it would start to force sales.
Well, actually not.
No.
We have very liquid credit markets. Come on. Every time you turn around, there's all sorts of people who are re-leveraging their assets.
Real estate moves pretty slow, you know.
You can re-leverage anytime you want, and there's a lot, and there's flows coming off that money. My God, look, let's say we had a 0.2% tax rate on real estate. Well, in theory, you should be able to make enough money off the real estate to cover that all by itself. Just the flows in terms of the rent you receive. You got to make some. Well, look, if you're making, what's a typical return on real estate? But let's say you're making a 6%
let's say cash
return,
on cash, 4%.
Yeah, what was it? 4%, 5%? Well, you could easily pay 0.5%. Just pay it out of that flow.
Yeah.
And again, remember the upside of this is like you could get rid of capital gains taxes.
But you're taxing cash flows. Wealth could be the actual equity in the real estate.
Right. It would be based on your equity. It wouldn't be based on the total value of the property.
And who evaluates that and how often?
Well, you asked me what I would do. You didn't ask me how I would do it.
I know. Because
I
that would take all day.
appreciate, well, and it's complicated. I'm not arguing that for a second. But just work with me on it for a second, because let's take real estate, residential real estate, your homes, right? Look, we should have a very liquid market in residential real estate. Not because real estate agents should make money. That's not what I'm saying. But we should be able to move. Look, I got a new job. I should be able to easily move to where I want to go. Equivalently, my kids moved out. I need a smaller house. I now have kids. I need a bigger house. We should be able to buy and sell and move homes around relatively easily to meet our life's needs where we happen to be. But right now, it's such an enormous cost to thinking about selling a house. I'm from California. You're from there. So you know what happens if you sell your house and move someplace else. Well, for one thing, of course, we have to do the big increase in interest rates, which is obviously a huge problem. In California, you lose your Prop 13 property tax protection. That's a big hit.
That's a huge issue.
And of course, unless you're are covered by one of these one-time tax-free things, you could get an enormous capital gains hit. So suddenly, I have a job that's much farther away. My kids moved away, but I can't afford to move. I can't take the capital gains hit. I can't take the increase in interest rates. I can't take the increase in my property taxes.
Residential commissions are ungodly high.
Yeah.
Yeah.
So if you work through all this and you say what we've done is we've created a very inefficient housing market because the housing market doesn't adapt to individual needs, and that is a problem. You want more liquidity, you want more sales, but that means making the actual transaction process cheaper, not more expensive. And that means finding ways of operating these markets, regulating these markets that encourage liquidity, but we still have enough money left over to pay for roads and schools and all that kind of good stuff.
Since we're talking housing.
Yeah.
Near and dear to my heart. I was talking about this the other day. I think we did a post on it. Was so much about interest rates and what the Fed's going to do, and CPI and core CPI, right? Driving a lot of their decision making, obviously PCE too, but the biggest input to CPI, as I understand, is shelter. Roughly 33% of CPI, 40% of core CPI, and shelter effectively being rent. Okay.
Yeah. Or the equivalent.
Or the rental equivalent for your home. Yeah. So generally connected there. I've lived in two places most of my adult life, pretty much, Los Angeles and Nashville. And they couldn't approach their housing markets any more differently than if they tried. Los Angeles, highly regulated, rent control, bordering on rents. Well, there's statewide and then there's local.
It's getting worse.
It's getting worse. And I don't think that will stop. I think that they somehow, some way see what New York does and want to emulate it as if that's worked. Not to mention the climate locally in a political level of rent vacancy, eviction moratoriums and rent increase moratoriums for COVID, which somehow lasted 4 years out there. It's just insane. Projects, it's 40+% of every dollar spent on CEQA. Then you're getting sued by all types of bizarre organizations that really have nothing to do with the name of the organization that supposedly they purport to support. And it's just very prohibitively expensive to build out there for so many layers. The Sierra Club and the Coastal Commission. And then you have Nashville, which, they do have zoning, right? Yep. Texas, I don't know if they do have zoning, but
they're getting more of it now.
They're getting more. But Nashville, they do have zoning. But if your zoning allows you, you can build.
Right.
It's more just the economics. And so what did we see over the last 3-4 years, especially late 2020, 21, early 22? Rates are cheap. What do developers do? Buy up a bunch of dirt, take out a construction loan, build a bunch of units. They all start coming online 23, 24, 25, into 26. There's an oversupply to the market. And what have we seen here? Rents have, I call it collapse. They're down 5%. Effective rent. I advise some of our younger agents, they're in the prime renting stage. I think I was talking to you guys the other day. I was like, hey, every 12 months, shop around to other Class A buildings, and you're going to get probably 2, maybe 3 months of free rent concessions, all of it. And you have rents going down in Nashville, even though people net are moving here in droves. Los Angeles has had most years over the last 5 years, a net migration out, yet their rents keep going up. And it's like, it's not a housing problem, it's a supply problem.
It's a supply problem.
And so what is your opinion on the housing shortage? If we want to solve inflation, and shelter right now is at 3.7%. I don't even want to get into how they actually calculate that. It couldn't be more wrong. But how do we solve it? What's your opinion as an economist? Like, and then why do we not seem capable of getting this done?
Well, there's a lot going on in there. And again, you have to kind of unpack it into different pieces. You're absolutely right. LA, Nashville, the Southeast in general, a lot more ability to build, a lot of apartments coming online. Clearly, you're seeing that in terms of rents, as you said, coming down here. I should point out, actually, in LA over the last couple of years, asking rents have been flat. Flat.
I know.
They've not been falling.
I own buildings.
Yeah. So
flat. But
yeah, flat. They're not falling, but they're certainly not rising very rapidly either. And of course, for all the conversation about rent control, the reason that rent control isn't that bad in California is the one thing they have not done is the vacancy decontrol, which is to say, if a unit goes vacant,
which is insane.
Well, they haven't done it. They're not going to. I think it's actually built into one of the state constitutions.
A lot, even though we obviously have a decent amount of real estate people as an audience, even me being in real estate in California, 2004 to about 2000, probably first 10, 15 years, somewhere in there in my career, I didn't know about vacancy decontrol because that was a New York thing. And I wasn't trading multifamily buildings in New York.
Yeah.
But walk the audience through this vacancy decontrol concept.
Well, again, the whole idea is when a unit goes vacant, what happens to the rent that can be charged for that particular unit? And that is the most horrendous part of rent control. Where rent control destroys cities is when there is no vacancy decontrol. That is to say, someone moves out, you can't reset the rent. You keep it at this low rate. They even got rid of that in New York City. That's one of the reasons that New York City got out of its hole in the 1970s, where there were buildings being abandoned in some parts of New York.
Yeah, because just to frame it for the audience, imagine, you have an apartment building, even in a rent-controlled market like Los Angeles. Let's say a lady's been living there 20 years, and because of that, the actual market rent has vastly outpaced the annual increases. And she's paying $1,000 and market's $2,000, let's just say. If she leaves, she finds a house, she finds another building, medically something happened. You can then bring that unit to market at $2,000. That makes sense. In New York, it was, if they leave for any reason, you could increase it 5% and you have to offer it at like $1,050.
Exactly. That's the best you could do.
It's like forced subsidized housing.
Right. That is the dangerous form. We don't have that in California, which is one of the reasons that even with some of the state level controls being put into place, it hasn't turned into a complete wipeout yet. Now, if they do go after that, well, I'm packing my bags and moving out. I'm done with California as the case may be.
Is Mamdani pushing
Probably.
for that? Yeah,
Probably.
Let's just assume the worst.
But what's interesting about this whole thing, and I think this is the broader conversation to be had, yet again, go to the primary reason. Why is this happening? What is going on in our minds? And it boils down to a broader conversation, which is this idea that we have a housing affordability crisis in the United States. How many times have you seen in the papers these conversations about how incredibly expensive housing is? I don't see it in the data. Not even close. Single-family homes are more expensive, but if you looked at affordability relative to incomes, controlling for interest rates, the affordability we're at now in the nation is roughly where we were in terms of affordability from 1981 to 1987, during Reagan's years. That's where we are. We're not record unaffordable by any stretch of the imagination. Housing was way more unaffordable in the 70s.
So, interest rates were at like 20%.
Well, yeah.
Why do you think this is the narrative?
Well, go back to this idea that I didn't say this yet, but what I've said, really coming out of the Great Recession, something happened in that Great Recession, some kick to our collective brains where we've just turned into this nation of people who are whining about how terrible and tragic everything is. I call it the age of miserableism. And it really boils down to the idea that we're constantly looking for bad news. We're constantly looking for someone to validate my insecurities, my anxiety, by telling me it's not me, that it's the rest of the world, and it's just not fair to me. And this has really become a dominant part of the conversation, the dominant part, the story of fairness or unfairness, as the case may be.
Their fair share.
The fair share.
Yeah.
Where I point out, take California, for example, because we keep going back to her. So let's, again, your former state, my current one. What's interesting about California is you say, well, we have a crisis in terms of rents. Well, do renters in California pay that much more than the rest of the nation as a share of their income? And the answer is no, they don't. Just a little bit more, but only a couple percentage points. And yes, I know that rents are much higher in California, but so are incomes. And that's the key. In fact, if you paid, let's say you're in LA and you're paying 38% of your income for rent, you move to Nashville and let's say you're paying 28% of your income for rent. The reality is you're better off in LA because your leftover money after you're paying your rent, because incomes are so much higher in LA than they are in Nashville, ultimately, net of your rent, you're making more money in LA than you are in Nashville. So in a sense, you can't even argue that people are all truly worse off. Now, part of that is the fact that lower income folks are just not allowed to live there. Understand that when you said people are leaving California, they are, but they're leaving in part because they can't afford to be there, which is exactly how the price mechanism operates. Look, why do economists go on and on about the price mechanism? Why do we consider it so wonderful? Because for the price mechanism equilibrates supply and demand. By raising the price, you slough off the people who don't really value this, and you leave it to the subset of people who are willing to pay that amount of money for that particular thing, whether it's a pound of steel, a Cartier watch, or an apartment in L.A.
It's kind of the invisible hand theory.
That's exactly why they call it the invisible hand. The reason housing prices are so high in California is because there's not enough housing. And it makes me crazy because I hear smart people in California say out loud, smart people I know are smart, and they'll say to me, we have a shortage of affordable housing. And I said, that's completely illogical. We have a shortage of housing, which makes it unaffordable for a certain group of people. Yeah. But not for other people. They're affording it. They're there. They're renting. They're buying.
What can we do at the local level to foster more housing construction?
Get the hell out of the way.
Yeah.
It's not complicated. Yeah. And again, what do you hear? Do you ever hear there's a thing in the big thinkers on the economy. Think of guys like Milton Friedman. What these guys broadly recognized was the idea, the big problem with government is once government starts doing something, it's really hard for them to stop doing it.
Yeah.
And this is one of the reasons why a lot of right-wing economists are against regulation. It isn't necessarily because they don't see the value of the regulation right here, right now, but rather the recognition that once you start regulating, it's really hard to stop regulating. And there were a lot of good reasons to do each of the things they've done when they did it in LA. And yet when you add it all up, what we've done is we've created such a mess of rules and regulations that even the very bureaucrats who are in charge of handling this, they don't understand what's going on. They can't figure it out. I mean, I have a buddy of mine right now who's trying to get a simple permit to do a little bit of grading in his backyard. And he's got 2 departments in the city of LA who can't agree on whether or not he needs a permit. And they keep arguing with each other. And it's been going on for 4 months. And he's just like, I'll get it or not get it. I don't care. Just make up your minds. And he's got one person over here who says, you got to have a permit. And this person's over here who you get the permit from is like, I'm not giving you a permit because you don't need a permit.
And is that happening at this, the city level, the state level?
Yeah, just basic person at the desk level. You've created such an incredibly complex system
Yeah, I think so many of the problems people have, not just related to housing or getting permits for their backyard
Yeah.
grading, it really, so many people talk or focus on the president of the United States or maybe the governor, but I feel like an overwhelming majority of whatever the solves or fixes or solutions that they either think would work or potentially would like to come up with, it actually is more of a local level problem. But those are the elections that get the least attention.
Absolutely.
Yeah.
And they get the least attention, and very much they become incredibly important. And it's not just rules and regulations. It's even the attitude of the people you elect. I mean, one of the changes, and we talked about this earlier. One of the things that has amazed me was how in 2 years under a new mayor, San Francisco feels like a completely different place.
Yeah, NDA.
NDA.
Yeah.
And they haven't changed the rules and regulations. It's still an incredibly hard place to do business. But just having someone standing up and saying, no, we're going to have our doors open. We're going to listen to people. And you know what? We're going to make things happen. We're going to try and help you as opposed to just being a barrier. Even basic leadership can make a big difference when it comes to these kind of conversations.
That's why I got to vote for my boy Rick Caruso in L.A.
Ah.
You know, he's a Trojan. I know you have some ties to UCLA, but
I have one or two, but USC is a good school.
USC is a great school. You know, my degree has appreciated since I went there. Fight on.
Actually, it has.
Yeah, I know.
Absolutely has. No, it's a fantastic school. They've done some great stuff down there.
What is it about rent control and stabilization? Like, what is it that really seems to make either the housing shortage worse? I don't want to say the affordability crisis, because again, you and I think are on the same page there, but what is it about those? You see these politicians, I'll pick on Mamdani.
Yeah.
You know, we need more affordable housing. And I have no doubt that their intentions are pure. Like they really think that this is the way, you know, vacancy control.
I wouldn't use the word politician and pure in the same sentence ever, personally.
Fair enough. I'm trying to be on both sides.
All right.
No, but I really do think that most of them, like, they believe that some sort of rent control, rent stabilization, or vacancy control is the way, and yet it seems to hurt the people that their constituents.
Absolutely.
Absolutely. But haven't we been doing this 30, 40 years? Like, at what point are they going to
30, 40?
Yeah.
Go back in time. I mean, I actually had one of my folks, they were looking around civil literature, and they found this great, like a picture of some graffiti they found on a ruin in ancient Rome. And basically, the Roman graffiti could more or less be translated into the rent is too damn high. People have been complaining about rents since time immemorial. And there's a very simple reason for that. We spend more on housing than anything else. It's always been a dominant share of the household consumption basket. Ergo, it does have the most profound impact on our sense of well-being.
Yeah. The American dream.
The American, or the Roman dream, as the case may be. This is part of who we are, and I think politicians take advantage of that, right? Whether you're Mandavi or even in his own way. I mean, look, because one of the things is the Reagan Republican is long gone. The Milton Friedman Republican is long gone. Go back to versus Harris. They're both populists, and they both had their own brand of "you're getting screwed," fostering, if you will, feeding this insecurity we all have. We all want to know that it's unfair to me, and
Bernie sent the 1%ers.
Exactly.
There's too many billionaires.
Well, I agree with him on that, actually. That statement I agree with.
There's too many billionaires, but if I ever find myself a billionaire, that'd be pretty cool.
I would be very cool. I don't have a problem with billionaires. I just think billionaires should be paying more. They should be carrying a little bit more of their fair share.
Can we drop a fair share in there?
Yeah, we can drop a fair share.
The billionaires need to pay their fair share.
I'm fair with that.
Is the American dream of home ownership dead?
No, absolutely not. Come on. Ownership rates today are basically above where they were 25 years ago. People own houses. In fact, that goes back to the idea that, what is one of these silly stories around us? I saw a Gallup poll not too long ago where people think it's the worst time ever to buy a home. It's not. I mean, it's not as good as it was from 2010 to 2020.
Yeah.
I'll grant you that. In fact, that was a record period of affordability. The real question is why weren't people buying more homes? And the answer is, well, the story, the narrative, because through that entire period of time, I remember in 2019 when Mark Zandi, who, by the way, is one of the most wrong economists, who is constantly in the news, was yet again telling everybody that housing was about to have a collapse. It was incredibly unaffordable. Prices were going to fall. And people were not buying homes because they believed this nonsense, despite the fact that when you sat and looked at the data, housing was record affordable. So people have this sense that housing is unaffordable. I have kids walking up to me all the time going, it's not fair. What's not fair? My generation will never be able to buy a home. And I said, well, how old are you? I'm doing 26. Okay. When in American history, when in global history, has it ever been easy for a 26-year-old to own a home? When has it ever been easy for a 26-year-old to afford housing, period? When I was 22, 23 years old, I was sharing a crappy home in Buffalo, New York with 3 other guys because that's what you did. Yeah. Nobody has roommates anymore.
Or there are parts of the country, you may choose not to live there, but there are parts of the country at 26 you absolutely could go buy a home.
You could.
Yeah,
if that's what you want.
Yeah. And they're very nice. Rochester. I grew up right out.
Prices are way up in Rochester, by the way.
They are. They actually really are. But I grew up in Cleveland, Ohio, in some amazing communities, and you go there and the home's nice. Again, it's not, you don't have a view of the Pacific Ocean, but
Detroit, Michigan.
Detroit, yeah. Some nice
great deals.
Detroit.
Great deals in Detroit.
Well, yeah. Sure. That's one way to look at it.
Yeah.
Let me talk to you about you for a second. Like, what first got you interested in economics?
It was interesting. It came to me really secondarily. I remember being in a managerial economics class, and it was a guy who taught a great class, Ron, what was his name? I can't remember his name. It was at the University of Rochester. And what was fun about him was how he would talk about the world and why the world operates in the way it does. Just taking things that I would have never thought about or noticed. Why do stores put certain stuff up front and certain stuff inside? And what are they doing? And he just started explaining it in terms of economics, in terms of incentives, and how businesses are I'm not going to say manipulating the system, but they're reacting to how human beings operate, to what our incentives are. And just those kind of interesting little stories just pulled me into this story about thinking of the world in this economic sort of way. That was an MBA program I never finished. I got so intrigued with that stuff. I started picking up books. I remember talking to a bunch of the PhDs there, and I said I was thinking about going for a PhD, and every one of them said, "Don't do it, don't do it, don't do it," and I did it.
In economics.
Well, actually, I have a PhD from the business school at UCLA, so I'm a graduate of the Anderson School.
Anderson School,
yeah.
Sure.
So I have a PhD in management, but technically I'm an economist. So for me, I just got pulled into it, and it's interesting because as much as I loved it, I then went into academia itself. And for a few years, I just was a pure teacher. I was at Clemson University, speaking of football teams, for a number of years. Great faculty, the whole bit. But I also immediately realized that's not what I want to do either. Because, well, as powerful and important as economics is to teach, and I don't think kids learn nearly enough economics, at the same time, I felt like, particularly in the state of modern academia is awful, particularly in economics. I mean, the trash they put out, the things they pursue, economists are as subject to the narrative as anybody is. And I was very quickly just dismayed and bored by pure academia. So I ended up back at UCLA working for the Forecast, really cutting my teeth on what I would call taking economics to the real world. And then, of course, leaving in '06, 20 years of having this company where more or less I am an economist, but I do so in a private sector sort of place. I'm running a business. I have to worry about profits and losses and clients and all that kind of stuff.
That crazy stuff.
But I still do economics. That's what I do on a day-to-day basis, and that's why I love what I do.
So I'm getting to Beacon here.
Yeah.
So you're at UCLA. You're doing the forecast, which is a big deal.
Yeah.
And my understanding is you more or less, start, we call it predict in the past tense, but like you start sounding the alarm about this housing bubble thing.
Yeah.
And you were kind of telling me at breakfast, your boss wasn't too happy with
It was
that.
not. He did not agree with me. He was in his own world, and this goes back to emotions, right? I would tell you that the guy I studied under, a guy named Ed Leamer, he just passed away this year, as a matter of fact. Brilliant mind. Could not have landed with a better dissertation advisor. I learned so much wisdom for that man. But at the same time, as smart as he was also very subject to his own personal narratives. I don't know if you ever heard of this term, the Nobel disease.
No.
So look up Nobel disease, and what they do is they go through all sorts of people who've won the Nobel Prizes, and they talk about the crazy stuff they believe otherwise. So you have incredibly brilliant minds who believed really preposterous things. And what they've shown is that the smarter people are, the better we are able to justify our weird beliefs, our biases.
Yeah, your own insanity.
Our own insanity.
Mm.
And that's very much what happened with this guy. It was almost like he was threatened by the fact that I was coming up with a different kind of story, a different kind of thought about the world, and he responded in an emotional way, and he more or less rejected it because I thought of it. And it's interesting because even after I left and the world did collapse, never quite heard the mea culpa. I should have.
You never sent you that I'm sorry text?
Never got that I'm sorry text. But that's okay.
Who's influenced your career the most?
He did.
Yeah.
Ed Leamer, absolutely. He influenced. He had a tremendous influence on my career. I think that he taught me a lot on how to communicate, how to think about economics. There's no doubt about it. Even if our relationship didn't end up as good as it could have been, I still owe a lot to him. I've had other incidences. I had one when I was working with a hedge fund in New York. I actually, for about 8 years of that time, there's another guy on the board named Alan Greenspan.
I've heard of that guy.
And, and I got to tell you, I walked away from me knowing him and working with him. It's just phenomenal, such phenomenal respect for that man. Incredibly intelligent, but not aggressively so. I mean, very self-assured, knows what he knows, doesn't suffer fools, but then again, he doesn't bother fighting with them either. Such composure and in his own way, kindness. So he was a phenomenal influence on me.
What's the best piece of advice you've ever received?
Believe your model, but don't overbelieve your model. And you say, what is model? Well, in the case, I'm talking about an economic model. But I think the broader story is, everybody has a philosophy. Everybody has rules that we live by. And that's good. You need those. But don't overbelieve it. Sometimes I get asked a question like, are you a Keynesian? Are you an Austrian? Are you a monetarist? And what I like to point out is each one of these schools of thought brings something to the table. They're not all correct. They're not all incorrect. They all bring a value. They all bring a story. And if you're a good economist, you absorb all these schools of thought. If you only believe in one school of thought, you're no longer a researcher. You're no longer an analyst. You are now a priest.
Yeah.
You are now a religious zealot who you have one point of view and you're going to sell that point of view no matter what.
Sure.
And that's where you've crossed the line.
And so in 2006, you had a point of view that there was a housing bubble and there was a lot of concern. It ultimately led to you leaving the Anderson forecast and starting Beacon. Tell us about that. How was starting that business? Share with the audience what Beacon is today. What do you guys focus on?
Yeah. Well, obviously, it was. I think as a lot of entrepreneurs start, I didn't start because of some big vision. It's funny. I know a lot of kids today. What do you want to be when you grow up? I want to be an entrepreneur. We didn't. No one said that when we were kids, right? I mean, that's not what you wanted to be. Most entrepreneurs are pushed into that position because you got to pay the mortgage. And so that's what happened to me. I knew I had to leave. Wasn't sure what I was going to do. So I came up with a name and put a hat in my head and said, let's see what I could do here. And it worked out great. Here we are 20 years later. I got about 20 people. We do economic research. We do policy analysis. I do a lot of speeches. I talk to 100 groups a year about what's happening in our economy and how to think about it. And yes, some of that's very acute. Are we going to have a recession the next year? But some of that is the bigger stuff, which is narratives versus reality, and how, in a very real sense, we're all subject to these biases, and we all have to recognize those issues in ourselves if we really want to make good decisions. So yeah, it's a lot of fun. We do economic development work, all sorts of stuff. I learn something new every day.
What's the number one question you receive over and over? Are we going to have a recession?
Are we going to have a recession?
Yeah.
What's the stock market going to do? That answer is always...
What stock should I buy?
Exactly. What stock should I buy? Where do you put your money?
Yeah.
Where do you put your money? That's always...
Put it back in the business.
Yeah.
You might have already touched on this, but like, what do you see as the biggest red flag to today's economy?
The external accounts.
Yeah.
The capital inflows. And again, people aren't paying attention to that. Yeah. That's
slowing down or stopping.
Yeah. And if that slows down, we're in big trouble.
You made a prediction 2006 that, certainly from your boss's perspective, that a lot of people probably disagreed with or thought was, if we call it controversial. And in hindsight, it's not.
Yeah.
But what is one prediction about the economy that you think will happen over the next 5 years that people might find surprising or controversial or disagree with?
Well, right off the bat, the fact that I point out that this quality of life in the United States has never been better is something that I get a phenomenal degree of pushback
I was going to
from.
say you get some
from the left and the
comments,
right.
Yeah,
absolutely. It's amazing how much people want to push back on this. They have this weird idealized version of the past that never actually existed. That's certainly one thing.
You think so? Basically, the biggest myth is that the U.S. housing market isn't affordable.
Exactly.
Yeah.
And no, that's the Gallup poll. It's the worst time to buy ever. Not even close. Is it a good time to buy? Period. Probably not. But then again, a house you buy for consumption. That's what you always have to appreciate. And you make money on it on top of that, great. But in the end, again, this is the single most important consumption good in anybody's life is where they live. And that's just something we have to make the right decisions on that particular front. But this idea that, I need to be making X return on this, well, not quite.
You saw the housing bubble. I think you also came out early and said, hey, this will be a big V shape in COVID. What was it that, in your opinion, allowed you to see those things when maybe others, it wasn't as clear?
Well, go back to the fact that I think of the economy from a real world Main Street sort of way. And the argument here is what causes a recession and what determines how bad it's going to be. The answer is to what causes a recession. Well, that has to be some rapid change in aggregate demand. That is to say that some demand in some part of the economy rapidly declines. And as a result of that, the resources, whether it's capital or people who are assigned to that sector, suddenly have to go out and find new jobs, new careers, new buyers. And that doesn't happen overnight. That's complicated. You can't just simply reassign people and capital to different uses overnight. Well, those frictions is exactly what causes a recession. Now, in the case of the Great Recession, the real problem was in the run-up to the Great Recession, you had a huge amount of resources going to building homes. huge amount of resources going to financing,
the
the
financing
purchasing
is
of those
insane.
homes. You had a huge amount of resources going to the big increase in consumer spending we saw, driven by all that high net worth, driven by those homes. Well, when push came to shove and the market started to collapse, well, all the demand in those sectors went away. You saw a pullback in consumer spending, a pullback in home building, a pullback in home finance. And all that, of course, created the vicious cycle we know as a recession,
Yeah.
which is to say people get laid off. They don't buy stuff, which hurts other parts of the economy. Now, in that case, the economy in 2010 had to be substantially different than the economy in 2006 because we had to let those parts of the economy shrink back to normal sizes, and that's a painful process over time. COVID was completely different. That was actually a true supply shock. It was not a demand shock. We were all happy and doing fine until we were told we could no longer go to restaurants.
Yeah.
And when that happened, when that had happened, well, yes, it was a huge shock to the system, but it wasn't that the economy was out of whack. We didn't have a huge growth in certain parts of the economy that suddenly had to be pruned back. It was just a matter of getting the damn vaccine in place. COVID was, as I'd like to point out, was the deepest recession in U.S. economic history. It was also the shortest. It lasted 8 weeks.
Yeah.
So it was not that big of a deal. But narratives are important. And the real issue with COVID was not COVID itself, but the narrative, the idea espoused by many quote-unquote famous economists like Nouriel Roubini and Mark Zandi. Oh, this is going to cause a depression. No pandemic has ever caused a depression. That world has never existed. What are you talking about? And the answer is they're not talking economic logic. These guys make a living saying big things to newspapers so they have headlines, so they can sell books or sell whatever. So they go out with that stuff. That becomes the story, the operative story. And the next thing you know, Jerome Powell, not an economist, just some lawyer, dumps $5 trillion of quantitative easing on our economy, expunds the money supply by 40%, sets off one of the biggest increases in asset prices this nation has ever seen, sets off an enormous increase in government borrowing. Because remember, the ratchet effect, once government starts spending money, they hate to stop spending it. The reality is Jerome Powell enabled a huge increase in spending, and we've never gotten over that. So Jerome Powell's ham-fisted actions, completely unnecessary, are things that we continue to deal with today. And if my worst fears come true, the money flow gets turned off, interest rates go up, we go into this debt spiral, and you could trace it all the way back to its root source. The answer is it's Jerome Powell's decision to fight off a depression that was never going to happen, to release that money into our economy. That's where it started.
Damn Jerome Powell.
Absolutely.
I'm just a real estate guy who's been pissing me off for some time now.
Yeah, well, I mean, it's the Federal Reserve is a political beast.
I was going to say, do you think it's politicized?
Absolutely. It's always been
Of course
political.
it is. Of course it is.
Right from the dawn of time has been political.
I was listening to some other podcasts, and they made a great point. I had never thought of it. He's like, hey, do you think the Supreme Court's politicized? Like, of course. Like, presidents pick the justice that they think, as we call politically, is politically consistent and aligned with their belief system. And that's why Supreme Court justice picks are such a huge deal. And they're so highly contested and fought after. He's like, it's the Fed. He's, somebody decided that this, a Fed governor or Fed chair was consistent with their belief system. And
but do we have a couple minutes? Let's do a little short story on this, because it's a great place to go on this. 1970s, inflation, right? Lots of inflation. Why do we have inflation? Not complicated. They're expanding the money supply too quick.
in the 70s?
Absolutely. You can see it 100% in the
That was
data.
because Nixon
Nixon was part of it.
pulled the dollar off the
There are a
ground.
lot of folks, part of it's that. But in the end, you had an one of the things that happened in the 70s was we moved away from, so yes, we went off the gold standard, and suddenly the Fed had to pick a monetary policy that wasn't controlled by the need to defend gold. And so you had to choose a rate of money supply expansion. They picked too high of a rate. Now, the answer to that is to yank it back. But the politics were, don't do it. In fact, I mean, Nixon actively tried to prevent the Fed from tightening because he didn't want interest rates to go up to interfere with his second election. It got very, very contentious. And every time someone would say, look, we just got to stop printing money, someone else would say, well, no, we can't do that because, it's too dangerous for the economy. It's too dangerous politically, too dangerous economically. Well, that all happened right up until Jimmy Carter and, of course, Paul Volcker. And if you really want to read a great book, go read Paul Volcker's autobiography. And he talks about that whole exchange because Carter called him and said, hey, we need a new Federal Reserve chief. I'm interviewing folks. Would you be interested in the job? What would you do? And Volcker said to him, yeah, it's very simple. We have inflation because we're printing too much money. And if I got in there, I'd yank the money supply back. And, and it's going to be painful. Rates are going to go up. People are going to scream. People are going to be angry about it. And Jimmy Carter said, well, okay, thanks. And he hung up the phone and someone said, well, what was that? And he goes, Paul Volcker said, well, that's me not getting the job. Because no president in his right mind would hire me. What did Jimmy Carter do? He hired him. And what did Paul Volcker do? He cranked on money supply, caused rates to go up. People tried to get rid of him. There was talks of impeaching him to get him out of office. Huge anger. Jimmy Carter lost the election because of this. But ultimately, why did inflation go away? Because Jimmy Carter fell on his sword, hired Volcker to do the dirty work that had to be done. Go back to what we were talking about in terms of politicians and what they do. Jimmy Carter is maligned in political history. Honest to God, you look at his motives, he's as close to pure as a politician has ever been in our nation.
And he was not rewarded for
it. And he was not rewarded for it. He was not. But let's just say, unlike other presidents, I think he might be the one who actually makes it to heaven.
That's a good line. Fed funds rate, where do you see it going?
Well, you heard it. They're going to cut it, right? I mean, it's a huge amount of pressure to cut it now. Even if he doesn't cut it right now, he's gone next May. He's going to get a crony in there, and these guys are going to start cutting it. They'll start cutting it. Okay. And the answer is nothing. Because the short end of the curve doesn't control the long end of the curve. Yeah. I keep hearing, you got to cut it because mortgage rates we need to come down. Since when does the federal funds rate control mortgage rates?
Historically, they've been correlated, but then
very
September,
yeah,
they start with a 50 bip cut and rates flew up.
Yeah, and that's my point, right? It's very unclear how those two ends of the curve work with each other. They're weakly correlated, and the spillover is relatively small. And go to the next step, because remember I pointed out that the weakness here is their external accounts. If you cut the short-run interest rate, that causes the dollar to drop. That can, in a sense, cause long-run rates to go up again. So that becomes an enormous problem. So they might cut rates, but the answer is it doesn't matter. It's irrelevant.
Where do you see the 10-year in 12 months?
Going up. Drifting up slowly until it goes up more rapidly. Now, mind you, there's ebbs and flows. It's a bouncy number like any other financial asset. It goes around. But in general, I've been telling everybody, it's not going to come down. If anything, the 10-year bond ultimately has to go up more. When will it start going up? Well, when we start having to fund our own government deficit. That's when it's going to drive that thing up. And we could very quickly get into a very, very nasty, vicious cycle. With interest rates going up, the deficit getting larger, more borrowing, and so on and so forth. By the way, what happens then? It's one of the questions we didn't get to. Yeah. What happens then? Well, the answer is, we inflate our way out of it. Now, in a sense, the argument has been that the Federal Reserve is an independent body to prevent the government from using the printing press to hide its own inability to make the right decisions from a budgetary standpoint. But, first of all, the Fed isn't independent. Even if it's quote-unquote technically independent, politically is not independent by any stretch of the imagination. Second thing is the Fed has to constantly balance short-term versus long-term. And while it may be good in the long term to force our government close to default or into default because it'll finally train our government not to do that, the short run consequences of that would be enormous. And they don't want that to happen. The third thing they've done was they invented this wonderful, wonderful fraud called quantitative easing. QE, which look all over the place. You will find Ben Bernanke and Jerome Powell and the Central Bank of England all telling you that quantitative easing doesn't cause inflation.
It's a very pretty name.
It's a wonderful way of helping the world, and it doesn't cause inflation. Of course it causes inflation. It's nonsensical. And yet over and over and over, Jerome Powell, the Federal Reserve, former chairs, Janet Yellen, Ben Bernanke, have all said out loud that quantitative easing had nothing to do with the inflation that hit this economy from 2021 to 2023, which is profoundly
It was insane.
insane.
They were doing QE even as the inflationary prints, the CPIs were hitting like 5.5, 6. They were still QEing like a couple $100 billion.
Yeah, it was
And
slowed
pretty
down a
low.
lot by then, but then they started reversing it, quantitative tightening. And remember that well, you not remember, but Ben Bernanke used quantitative easing too. But how Ben Bernanke used quantitative easing was completely different than how Jerome Powell used it. Ben Bernanke used quantitative easing to put money into the banking system to prevent further defaults.
Yeah.
He used it to backstop the financial system. Because that money went into the banking system, it didn't actually increase the money supply that much. It sat there in the form of excess reserves.
Mm-hmm.
That's not what Jerome Powell did. Jerome Powell turned on the printing press, gave it to Congress, who fire hosed it across the economy directly to the consumer. So the kind of quantitative easing he did was substantially different, far more dangerous, profoundly dangerous for price stability for the U.S. So yeah, I do think we're heading to an inflation, a new big inflation. Is it in 4 years? Is it in 2 years? Is it in 8 years? I don't know.
Really shouldn't be called too late, Powell. It should be like too much.
Yeah, way too much.
Rome, too much, Powell.
It will go down as probably one of the two largest errors ever in Federal Reserve history. The other one happened back in 1930 when they said, just like the banking system failed, they made bad decisions and they should suffer the consequences of their actions.
Yeah, that led to a pretty bad.
That led to a pretty bad situation.
Yeah. Yeah. Well, hopefully the money keeps coming in from the foreign investors, right? To the tune of $1 trillion. That's a big number.
One plus trillion right now.
I did notice as part of like the negotiations, with other countries, the administration it seems like part of that isn't just tariffs and what the rates will be. It's them investing capital here. I don't know how serious those commitments are, but it's like Japan's going to invest $600 billion in this company. We'll see if it gets done.
But that's not the point. They're already investing here, whether they're investing directly or indirectly. That's the problem. Is money is coming here.
Yeah.
Asking more countries to make bigger commitments to send money here is more or less like walking into the bank and going, "Hey, give me more money or else."
Yeah. It's not always very efficient. I think the counter argument is like, well, where else are they going to invest? What other countries have stable system of laws? I mean, you've seen what can happen in China when you invest. Like, the government controls it, and other countries. Hate to say it, it's almost like it's kind of a race to the bottom. Everyone's doing worse.
Well, I mean, look, there's other places to put your money. There's Australia and Europe. There's plenty of developing nations out there. And then even some of the developing nations are now becoming developed nations. Think of a place like Chile, for example, which is still a good place. Not for a heartbeat would I suggest that people are going to take all their money and walk away. You can't. We're still 20% of the global economy. Mm-hmm. But that said, if that $1 trillion goes to $100 billion, that means we need $900 billion more of internal savings to cover the deficit.
That's going to be tough.
And you're only going to do that with a big hike in interest rates.
Well, that's above my pay grade, but not above yours. Dr. Thornberg, thanks so much for coming on the podcast. For everyone listening, be sure to follow Dr. Thornberg on LinkedIn and Beacon Economics at beaconecon.com. And if you found value in this episode, don't forget to follow me on X, Instagram, TikTok, and LinkedIn. Ooh, we threw a TikTok in there, Zach. I got a TikTok. Anna Kay, I got a TikTok. I got to do some dances. Just search Kyle Matthews C. I've never signed on to TikTok, so I don't want the Chinese to get me. And catch more inspiring conversations on the Matthews Mentality Podcast, wherever you listen. Chris, can't thank you enough for coming out to Nashville. It's been fascinating. It's really cool.
Great conversation. Very much enjoyed it.